Good morning, everyone. Welcome to this week's Research Morning Call. Today, we have a few stock counter updates. For results, we have Amazon.com, AMD, Tesla, SGX, and Suntec REIT. For update-wise, we have Lendlease Global Commercial REIT. For Phillip on the ground, we have Qualcomm, Keppel Pacific Oak US REIT, CapitaLand Integrated Commercial Trust, and CapitaLand China Trust. Followed by that, we will have our usual technical pulse, and we will end off the session with the SG Weekly for week 7. This is a disclaimer that the information presented is just for educational purposes and not financial advice. Now I'll hand over the time to Helena.
Thank you, Ikben. So actually, Glenn cannot make it for the webinar today, so I'll be presenting on his behalf for Tesla. So FY24 result of Tesla is below our expectations. Both revenue and adjusted PATMI were 94% of our forecast. Adjusted PATMI actually rose slightly due to higher energy storage and services revenue. So moving on to the positives, their delivery grew for the second consecutive quarter, which grew 2% year-on-year, followed by a continuation of the growth of the last quarter, which is 6% year-on-year. So this kind of suggesting a bottoming could be in place for the volume declines. Domestic China sales were a huge contributor. Their fourth quarter demand increased 25% year-on-year due to a more stable pricing environment. China's new energy vehicle, which include EV and plug-in hybrids, altogether it grew 43% year-on-year in the last quarter. Tesla's main competitor, BYD, grew at an even faster rate of 61% year-on-year. Tesla auto revenue was up 2% in the last quarter. Moving on to the negatives, the first one would be the margins back to a decline. So Tesla's gross margin contracted 130 BPS year-on-year. This is due to first lower vehicle average selling price from discount on their inventory vehicles in North America and price cut on the Model Y SUV in China. The second would be their lower production volume, which decreased by 7% year-on-year, and factory utilization rate. The third would be a decline in auto revenue, which it decreased 8% year-on-year, as the decline in vehicle ASP outpaced its increase in total deliveries. So this is actually the lowest gross margin they have since the second quarter of FY19, which had a gross margin of 14.5%. The second one would be the reduced ASP. We estimate Tesla's ASP to decline for the 8th quarter. Their last quarter ASP was down 12% year-on-year. They're actually the manufacturing suggested retail price largely remained unchanged globally. So we do believe the decline in ASP was predominantly due to the financing incentive to increase consumer affordability, with interest rate remaining relatively high worldwide. Another one would be their CapEx rise again. The fourth quarter CapEx actually increased 21% year-on-year due to the expansion in Tesla's AI computing and other R&D projects. So the increase was mainly to accelerate the build-out of Tesla's Cortex supercluster, which was to roll out the FSD version 13 and eventually unsupervised FSD in the US by the end of 2025. Tesla have guided their CapEx to be flat year-on-year for FY25. We remain cautious on Tesla in the near term due to several reasons. The first is the removing of the EV tax credit, lower emission standard, and China tariff. It could further lower demand and margins. The second is because the ongoing competition from Chinese EV manufacturers, particularly BYD, is still weighing on their volume and prices. The last one would be because of a significant revenue contribution from multi-year initiatives like their FSD, Robotaxi, Optimus is still several years out, like 3 to 5 years out. So steep valuation of 160x PE ratio for FY25 kind of suggested that this has already been priced ahead of time. So we reduced our FY25 revenue and PATMI estimate by 10% and 40% respectively to reflect the margin headwind due to softer pricing, lower demand, and US tariff on China export, and the EV tax credit removal. We raised our DCF target price to $265 and downgrade to sell from reduce. So that's all for Tesla. Now I move on to Amazon. So Amazon also released their earnings last week. Their fourth quarter revenue was in line with our expectation. PATMI outperformed due to the increasing operating leverage and cost discipline. their operating margin grew 3.1% year-on-year. So their FY25 revenue and PATMI were 100 and 112% of our FY24 forecast. The primary revenue driver is still AWS, which grew 19% year-on-year. AWS operation margin rose 7.3% year-on-year. It's driven by cost control and extended server lifespan, contributing to around 200 BPS for the margin. So in terms of the positive point, the first is obviously AWS maintaining its solid growth. So this 19% year-on-year growth actually marks its fourth consecutive quarter of growth above 15%. The growth was driven by ongoing cloud migration, strong demand for their Trainium 2, which is supported by good price performance, and increased availability of models with lower latency and cost. AWS growth remains constrained by multiple factors such as chips and motherboard supply chain delays, and also the early stage rollout of Trainium 2. So we do anticipate faster growth in the second half of the year as these constraints eases. Moving on, the next positive point would be their retail, which is still largely driven by regionalization and efficiency. So Amazon, they still remain focused on lowering the prices in order to meet the need of increasingly price-sensitive consumers. Amazon had the lowest online price for the 8th consecutive year, averaging 14% lower than other leading US retailers. Their efforts in regionalization have played a very key role in their cost management and efficiency gain. Their same-day delivery site expanded 60% year-on-year. The inventory storage efficiency grew 40% year-on-year. So as a result, their overall retail operating margin grew 1.9% year-on-year in the last quarter. We expect further cost reduction moving into FY25, given they recently just rolled out a redesigned US inbound network to refine inventory placement further. Another good point would be their capex rise seemed to have stopped. In the last quarter, their trailing 12 months capex jumped by 61% year-on-year. Over the past years, Amazon's commentary on future capex is always that it's going to be consistently higher. However, this time management indicated that they're going to keep capex steady. So a quarterly run rate of 26 billion would be expected to set the capex level for 2025. Moving on to the negative point, they do have pretty soft first quarter guidance. They expected revenue to grow 5 to 9% year-on-year. Compared to last year's, the growth was 12.5%. So this kind of missed consensus and our estimate for 12% year-on-year. The operating income is expected to grow negative 8 to 18% year-on-year, which also missed consensus. So the soft guidance is really due to the see of foreign FX headwind of 150 BPS. There's also the impact of the last year's leap year, and also the early retirement and decreased useful life of their servers. But all these factors we think are temporary and unlikely to impact Amazon in the long run. So our overall view on Amazon, everything's still looking pretty good. Both top and bottom line, we see both top and bottom line growth in AWS and retail. Their margins keep improving. We think the stock guidance is only temporary. So the only problem they have is probably the valuation is slightly full. They're still it's their PE ratio for FY25 is at 36.7x. Amazon is still riding on the rising AI demand in cloud trend, and they're unlikely to get disturbed by DeepSeek as much compared to other tech companies. In fact, we think they might even benefit from it as more people using AI model means further increasing the demand for cloud services. So we rolled over another year of valuation. We decreased both FY25 revenue and PATMI by 1% to reflect the leap year effect and changes in the useful life of servers. Due to recent share price trends, we downgrade our recommendation from buy to accumulate and raise our DCF target price to $270. Now, so that's all from me. I'll pass my time to Ikben.
Thanks, Helena. Now I'll be presenting on AMD. AMD released their fourth quarter results. For AMD's revenue itself, their fourth quarter revenue, it met our expectations. This is because their revenue is driven by their data center and PC segments. For their data center, it is driven by the strong demand for MI300X and EPYC CPUs, and also because the MI325 production started in fourth quarter itself. So that also drove revenue as well. For their PC wise, the revenue is driven by Ryzen CPU and Ryzen AI 300 series. For their PATMI itself, it fell short of our estimates. This is because of higher OpEx for R&D and marketing to compete for data center and PC market share, and also because of some one-off restructuring charges and taxes as well. As for the positives for AMD, they provided strong revenue guidance for the next quarter, which has not been seen before since second quarter of 2022. And another positive is that they continue to gain PC share against Intel, because this is the third consecutive quarter they achieved more than 50% year-on-year last 12 months revenue growth. As for their negative, we do see a possible slowdown in the growth of data center GPU, because based on the last 12 months year-on-year trend itself, it does seem like it is reaching the peak. However, this is consistent in the GPU space, because Nvidia has also uh, experienced a slowdown in growth since second quarter of last year itself. Yep. And another negative is that they are still dragged by their gaming and embedded segments, even though both of these segments are still represent a small percentage of their revenue. Another negative is that their net profits are dragged by the high OpEx and one-off charges, as mentioned just now. So for AMD itself, we downgrade to accumulate, and we lower our target price from 170 to 120. This is because we have reduced expectations for their PATMI, because we do think that they will continue to invest in higher R&D and OpEx to compete for the data center and PC market share. And especially in the middle of this year itself, they will start producing MI 350 chips. So we do think that they will have a higher OpEx in order to market this and compete with Nvidia's Blackwell chips. And we also raised our WACC to 7.9%. Previously, it was 7.4%, in order to address some uncertainties with regards to tariff policies and DeepSeek developments, which we are still closely monitoring. As for our outlook for AMD itself, we do see that the production of MI 350 chips will continue to drive data center GPU growth from second half onwards, because it will only start production in the middle of this year. We do expect OpEx to remain high, as mentioned just now, and we do see a strong PC segment growth likely to continue, because their momentum is very strong against Intel, which has a declining revenue growth in their PC segment. Next up, I'll be presenting on Qualcomm. They also released their quarter one FY25 results, which is the quarter for December. So for Qualcomm itself, they have two segments. One is the QCT and one is the QTL. The QCT segment refers to semicons. So refers to designing and selling semicon chips, and also 5G modem chips used in smartphones and PCs. As for their QTL segments, it refers to patents and licensing for their 4G and 5G chips, and also royalty charges. For their revenue itself, for the latest quarter, it beat their guidance. It was plus 17.5% year-on-year, and they also provided strong guidance for the next quarter. A positive for Qualcomm is that they announced that ARM withdrew threat to terminate their license agreement. So a brief context for this is that ARM previously sued Qualcomm because Qualcomm acquired Nuvia, and Nuvia a brief context is that Qualcomm uses ARM's IP to produce the chips, and Nuvia also uses ARM's IP to produce their chips. So when Qualcomm acquired Nuvia itself, ARM saw that as a threat to their business and sued Qualcomm for it. And this is a very huge announcement, because Qualcomm produces almost 100% of their chips using ARM's IP. So when ARM threatened to sue Qualcomm over it, it was quite a big negative for Qualcomm. However, because ARM decided to withdraw this lawsuit, it is a positive news for Qualcomm itself. And another positive for Qualcomm is that the newly launched Samsung Galaxy S25 series will be powered by Qualcomm's Snapdragon 8 Elite chip. A negative for Qualcomm is that Apple plans to develop its own modem chips, so it will slowly take away sale from Qualcomm itself. And Apple represents quite a material portion of Qualcomm's revenue itself. So this is quite a material. This will be quite a material impact on Qualcomm's business. However, as for our outlook itself, we do see that there are positive guidance and also diversification away from Apple itself is a positive for their business because Qualcomm has other significant clients as well. For example, Samsung, Lenovo, and Microsoft. So we do think that they were able to ride this through. And smartphone demand also seems to be increasing. However, it may be plateauing as can be seen on the graph on the right. Yeah. However, we do think that this demand will still continue for a few quarters. Yeah. That's all from my end. I'll hand over the time to Darren.
Yeah, thanks, Ivan. Yeah, now I have two Phillip on the ground. So the first one is Keppel Pacific US REIT. We hosted them for a webinar last week and coincides with their FY24 results as well. So for core, their market cap is 250 million. It's a pure play US office REIT together with the other two peers, Manulife and Prime. So for their performance, MPI is down slightly, but that's because of higher vacancies in the portfolio, as well as increased repair and maintenance expenses, basically higher property operating costs as well. So their all-in cost of debt is flat, 4.45%, and they have about 10% of their loans that are expiring in the fourth quarter of 2025. So their all-in cost of debt, 67% of it is fixed, and their gearing is 43.7%. ICR is at 2.6 times. So for the outlook for this cost of debt, we expect it to increase slightly because 100 million of interest rate swaps are expiring in the third quarter of 2025. So after which, if interest rates still remain at these current levels, the cost of debt will likely increase, but will remain below 5%. Yep. So for the portfolio valuations, that was a surprise to us. First, the portfolio valuations, it was stable year on year at 1.33 billion. So basically, if you account for the capex, it's down for 46.7 million because they basically their capex for this 2034 was 46.7 million, and if you account for that, basically the valuation is just down based on the capex. Yeah, so what impacted this was higher cap rates and discount rates, but it was offset by better operating performance of the properties. Yeah, and the portfolio occupancy is at 90%. For this first quarter 2025, there will be a huge expiry at Plaza. So that's one of their buildings, one of the assets, and as a result, portfolio occupancy will dip. So we think portfolio occupancy for FY24 will likely end around the 88% level. And for reversions, it's still flat. So for FY24, it was down 0.5%. For the fourth quarter, it's up 1.7%. So it's very flat. It's like around minus low single digit to plus low single digits reversions. So we think it will likely remain around these levels. But the silver lining is that for them, the in-place rents are still currently slightly below asking rents. So they still have the potential to have some positive rent reversion. So it's at 2.7% below asking rents. So for the outlook, transactions volumes are still very slow for the US office markets, but with the interest rates possibly remaining high and likely will decrease this year, next year. So the markets might improve, but the banks are still not lending. So any transactions mostly are still pure equity. And right now, the physical occupancy for core is at 72%. And we think going forward for FY25, the physical occupancy will remain around this level. So 70 to 80% is about 3.5 to 4 days work week in the office. And for the fact that Trump is mandating all federal employees to come back to office, that might help demand. And it's actually effective by this month or so, the fact that the federal employees will have to return back to the office. And yeah, so dividends are expected to resume in 2026. Yeah, we do not think dividends will they will resume dividends before that because they still have to spend on some capex to secure some of the tenants, the leases as well, and as well as the fourth quarter 2025 10% of debt expiring. So the plan now for them is to resume dividends only in 2026 and not 2025. Yep. Next slide, please. So I'll now run through CICT's results. So CICT, their biggest exposures in Singapore, 95%, and their distributable income was up 6.4%. So that's mainly due to better operating performance and contribution from Ion Orchard as well. So if you strip that out, because if you remember last year when they acquired Ion Orchard, they did an equity fundraising. So if you strip that out, the DPU for second half 2024 is 5.52 cents, but this because of the EFR is 5.45, so it's flat year on year. You take a look at the top right hand chart. That's the MPI and gross revenue performance. So the better operating performance was, the higher revenue and MPI was from better operating performance, but it's partially offset by the income from AE, the absence of income from Galileo due to its AEI, as well as the 21 Color K, which was divested in 11 November 2024. So one more thing to note is that the Ion Orchard started contributing, but it's not in this line, gross revenue and MPI, because it's JV accounted for. So just a one-line item. Yeah, so for the portfolio occupancy, 96.7%, retail remains very resilient, 99.3%. Office is slightly weaker, mainly the overseas office, and integrated development is 98.9%. Yeah, so for FY24, their reversions were very resilient. Retail was at 8.8%. So suburban malls and downtown malls were around that level, and office was at 11.1%. Yeah, so going forward, for the outlook for retail, they still see some strong tenant demand. So there's a lot of interest from new cafes, overseas F&B concepts, and the weak point in retail is the highest ticket items like fine dining and luxury sales. They're still slow. When they plan to acquire Ion Orchard, basically what I'm trying to say is that the performance for Ion Orchard is better than what they've previously already underwritten, or rather the expectations. So that's a plus as well. And recently, MM2 Cathay, they've not paid FCT, but for CICT, it's a different case, as right now their cinemas basically account for less than 1% of GRI, and they are still contributing as compared to the Cathay, which is not contributing and is impacting just a small impact on FCT. Yeah, so for retail, there's a mid-single digit reversion outlook for retail. And for SG Office, there is still potential for positive rent reversions, but it's more of a low single digit reversions, as the upcoming expiries are below market rents, but only slightly below market rents. So this is in comparison to Keppel REIT. So Keppel REIT, their expiring rents in 2025 and 2026 are more significantly below the current market as compared to CICT, which is just a few cents below. So there is still potential for positive rent reversions, and landlords are not under the drop rents because vacancies are low. Like IOI Central Boulevard, the is already around 80% filled. So there is a little pressure for the landlords to drop rents, as there's still demand for office space in the core CBD area. Yeah, so for CICT, they're paying a dividend yield of 5.5%. Yeah, so that's all for me. I hand over time to Meow Meow. Thanks.
Thanks, Darren. Suntec had their FY24 result, and then the results are mostly in line with our expectation. Performance in Singapore was still strong, and convention center revenue saw marginal decline due to lower large-scale events, but NPI was improved by more than 10% due to less manpower needed for the smaller scale events. And overseas assets remain the drag, such as UK and also Australia. Suntec has also successfully divested 58.3 million of the strata units, which is completing around 60% of their annual divestment goal at an average price of 24% above its book value. And this is reflecting the underlying value of the asset. And for positives, rental reversion in Singapore remain robust, achieving 22.9% for retail and 10.6% for office. And for negatives, overall portfolio valuation dipped by 1.2% year-on-year. And this is due to the cap rate expansion in Australia, which expanded by 60 to 75 basis points. and also on the back of the weaker outlook for their office asset. So this led to more than 10% decline in their office valuation. Now UK saw a marginal decline of 1.2% year-on-year. And for outlook, the incentives and headline vacancy rate in Melbourne is still elevating, and CBD area supply remains saturated and still uncommitted. This is leading to softening net absorption. Yeah, so we believe Suntec probably will take more time to backfill its vacant space in Southgate Complex and also 55 Curry Street. Meanwhile, Singapore office market recovered in second half 24, with relocation demand subdued by the high fit-out cost. So we expect strong tenant retention to extend into FY25, and this will support the high single-digit rental reversion for their office segment. And we also expect retail to continue generate around low teens, should be around 10 to 15% rental reversion in FY25. And this is driven by the robust occupier demand. And Suntec is also hedging 58% of its loan, and there's another 100 million loan due to be refinancing FY25. So we do expect cost of borrowing to creep up slightly to around 4.3% in FY25. So we maintain accumulate for Suntec REIT with target price of $1.33 and a dividend yield of 5.2%. Next slide, please. Yeah, so Lendlease released their first half 25 result last week, and it's mostly within our expectation. Though overall performance is still robust, retail rental reversion maintained resilient in first half 25, achieving 10.7% for retail and 1.2% for office. And the rental review for GEM office is also in its final stage and expected to be concluded by February 25. So we expect it to be at low teens rental reversion, and this is going to be retrospectively contributing to the revenue from January 25 onwards. Yeah, and DPU decreased by 14% year-on-year to 1.8 cents, and this is purely due to accounting treatment. As last year, they had a one-off pre-termination expense, pre-termination fee, and this is adding into the DPU, adding into the NPR part, but they never use it to top up DPU. Yeah, so the decline was purely due to accounting treatment. And for negatives, backfilling of the building 3 Sky Complex is taking longer than expected, with occupancy improving to 31% of the building, and last quarter was 8.1%. And this is bringing to the total portfolio occupancy rate to 92.3%. And although the new rental has already been marked to market, with average rental reversion of around 50%, but the actual cash flow can only be materialized from first half 26 onwards. And we do expect the biggest headwind to coming from the capital management front, as Lendlease reported the ICR to be at around 1.5 times, and this is on par with the MAS threshold of 1.5 times adjusted ICR. And although they don't have any further refinancing obligation in FY25, but there is a 200 million perpetual to mature in April this year. So we believe very likely Lendlease will issue a new perpetual with estimated cost of around 5%. And it is still lower than the current cost of 5.25%, and also significantly lower than the rollover rate of 6%. And for outlook, Suntec remain committed to divest GEM office, but it's like less likely it will happen before the maturity of the perpetual. And we believe they probably will divest the building with a slight discount to the latest valuation of 450 million. But the management is still confident that they can divest it at a positive yield. Finally, the long-awaited tenant Live Nation has already commenced their construction and begin to operate from second half 26 onwards. So with a capacity of 3,000 audience and higher than average JTO, and this is under a revenue sharing model. So we do foresee like substantial revenue uplift from the new tenant. We believe much of the downside risk has already been factored into the current share price, since it's trading at around 30% discount to its net asset value. And compared to pre-COVID period, Lendlease used to trade at 1.1 times price to NAV. We believe the current share price is very much discounted. So we do maintain a buy recommendation with DDM back target price of $0.74 and dividend yield of around 7%. Next slide, please. Yeah, so this is a Phillip on the ground CapitaLand China Trust. We don't cover the rate. So CICT had a pretty weak FY24 result, and also its outlook is pretty muted. They posted a second straight consecutive year of the double-digit DPU decline, as the weakness in new economy segment persists due to oversupply, and currency remain a headwind for CICT since Singapore dollar remains strong. And retail remain is a bright spot with NPI improved by 1.9% year on year. This is due to the stronger performance post 3 AEI work in its mall. Yeah, so on average, we saw a 14% uplift for its NPI of the 3 shopping malls. And for the new economy side, it continued to struggle. So business parks rental reversion declined by 4.5% year on year. Yeah, and its occupancy rate continued to decline following the departure of the anchor tenant at Alexander Innovation Tower. And logistics segment saw occupancy jump from 72.5% to around 98% after securing a new anchor tenant with around 8 years of the leasing period. But however, reversion still down by 25% year on year. Yeah, and this is roughly in line with the China's logistic rents. And on the capital management front, cost of borrowing lowered to 3.5%. A small onshore loan has been taken on. So last quarter was around 20%, and this quarter the exposure to RMB denominated loan is around 35%. So looking ahead, CICT will remain focused on keeping its occupancy stable in retail and also business parks. Logistic, we do expect another year of the headwind, especially with the higher US tariff impacting export-driven businesses. Yeah, so we do expect rental reversion for its logistics segment remain at the negative territory around like negative 20% to negative 30%. And but moving forward, we do expect foreign exchange rate risk to ease with like lower with weaker RMB yeah, going forward. So they're trading at a forward dividend yield of 7.7% and a 0.7 times price to NAV. Yeah, that's all for me. I'll hand over to Ding for technical pause. Thank you.
Thanks, Mel. Good morning, everyone. On to the technicals. Yeah, so first up, looking at the S&P 500, last week we continued to see a very choppy trading. So on Monday, there was a gap down and continued to retest the descending triangle formation trend line. And we have a support before rebounding towards the 6,100 level again, which we continue to have over at the resistance. So for the whole week itself, S&P was down slightly about 0.2%. For this week, I think we're still likely to see some sort of green consolidation going, unless we can see a close above the 6,100 level. So for now, resistance is from 6,075 to 6,130, and support is at 5,925 to 6,800. Next slide. Yeah, next one we have a technical sell for Yoma strategic at 0.075, take profit level 0.070 and 0.067, stop loss at 0.077. Last close was 0.075 on Friday. So for this trade, it hit our stop loss, but the initial trade idea was following a breakdown of a consolidation wedge highlighted in price also broke below the 0.075 previous support level, which turned into resistance, and coupled with a decreasing momentum could have led to price continuing its downwards pullback towards these two take profit levels. Next slide. Next one, we have a technical buy for Singtel at $3.28. Take profit levels at 3.48 and 3.55. Stop loss at $3.16. Last close was $3.28 on Friday. So looking at Singtel's chart, the stock has been mostly consolidating between $3.04 to about $3.19 since November last year. And recently there was a breakout. Price held a throwback of the $3.19 breakout level, which held as support. So that's a positive sign for the primary bullish trend to actually continue after a very long consolidation. And secondly, if we look at in November last year, there was also a bear trap pattern being formed where price actually opened below there was a gap down below the $3.04 level and then price subsequently recovered back above it very quickly. So that will actually force those short seller traders to actually cover the position, which also contributes to the bullish buyers. And lastly, when we look at the MACD, there's also increasing momentum as well, rising to levels last seen in October. So overall, there's a few bullish signs that could support the price to actually notch higher highs going ahead. Next slide. Yeah, so for a summary of the trades initiated for Yoma, here our stop loss, so it's down 2.67%. So that's all from me for the technicals. I'll hand over time to Paul to talk about SGX results. Thanks.
Yeah, thanks, Zane. So I'm covering for Glenn. I think he's at the DBS results briefing. So for SGX results, it was generally positive across all the various segments, and you're talking about the futures, commodities, currencies all doing well. The equities cash market, which is I guess the SGX, is also doing well. Maybe not the IPOs, but so across the board, it was better than expected, and it's all performing well. The negative was that the dividends didn't grow as fast as the earnings, and the next negative was that the treasury income, which is interest income contribution, continues to drop. But the outlook is that so far, when we were looking at the January numbers, the SDAV for January is still healthy at 11% year on year. The OTFX will continue to grow so long as there's so much volatility with Trump's policies, tariffs on and tariffs off. That has a huge impact on FX. And I think we raised our guidance by 14%. So in general, we are positive on SGX. I think the way to play SGX is that it's a leverage way to play the volatility that we see because of the new US administration. Just to help you understand, if you look at the revenue, the revenue rose 15%, but earnings can double the growth rate, about 30%. So what it means is that when the revenue growth rise, you don't really need to have additional increase in OPEX, which is staff costs and everything, because it's virtually like an online business. So you can scale up higher and you can get huge operating leverage. Next slide. I'll move on to Keppel's results. As the title suggests, what we're seeing is that if you go back a slide, as the title suggests, I think what we view is that operationally it'll be weak, but I think you'll be rewarded with the 5% yield because the company is still transitioning into an asset-light business. Yeah, next slide. So if you look at the results, the adjusted PATMI, so when you look at this table, there's a PATMI, a bit confusing. There's the PATMI that you see, the headlines that they talk about. Then there's normalized PATMI. So normalized PATMI, what it means is that you take out the legacy. Legacy means the REIT business that they had. Just do remember that they still own 4 billion of REITs in the balance sheet. So if you take that out, because they earn some interest income on that and some mark to market, that is what you get by normalized. But they also have valuation gains. So once you strip that out, the earnings was down about 5%. Mainly because of infrastructure. Dividends was unchanged. So the results was above expectations because we thought that the real estate will contract even more. Positive is that they continue to build the franchise. So they continue to build, I think there's 88 billion of funds under management. So that is the direction of where Keppel want to be. They don't want to, because they got their balance sheet is too heavy, so they want to raise funds and basically use other people's money to grow the business. The negative is the infrastructure. So infrastructure should have grown steadily, but I think they got some higher wholesale spreads, and also in Europe it came down because during the Russian war, the renewables did very well because there was a lack of energy and energy prices went up, or lack of electricity. So that's why their Keppel Met, which is their European business, did well. In terms of our earnings, we didn't really move much. We just raised our target price a little bit. But for us, I think 2025 in the near term, we do expect lackluster earnings. So there isn't really much earnings driver, at least for the first half. Because real estate is still weak, there could be a bit of pickup from Vietnam. So if you notice on the left, real estate is a big contributor, is one of their main contributor of earnings the last few years. But you can see it's down to -1, so loss making right now. Then of course mobile, which is their connectivity business, which is M1, that also is going to be soft because it's competition. And then softer renewable earnings, yeah, and because of the European situation, and also they still had some quite good wholesale rates which is coming off. But I think the main growth is that FY26 will be the big earnings driver because the new Keppel the new Keppel plant will come in, and then their submarine cables will turn operational, and then they can earn operation and maintenance fees on it. So of course you'll be asking, why earn this? Why still have a buy when there's not much earnings in the near term? So we still like it because we're still generating a 5% yield, and there's still 3 to 5 billion of assets to monetize. So and so when the monetization, they're still going to pay you special dividends. So just that in the near term, it might be a bit soft, but we like this company because they are really tapped into the whole data center business. They got power business, like we mentioned. They got submarine cable. They call it Bifrost. They also have funds. They also have funds to buy data centers, and they also have cooling solutions. So the whole data center infrastructure, they are primed to build it as there's a huge growth in data centers in Singapore and the whole region. Next slide. Next slide. So for Singapore, just as usual, we'll just run through some of the key data points. One positive thing for the banks, I'll just get a quick comment on what Glenn said later on. But for the banks, I think although interest rate margins might be contracting, the one big positive is that loans growth is picking up very strongly. So loans is the fastest in over 2 years, mainly driven by business. Tourism in Singapore is still holding up. Arrivals was about 13%. Most of it driven by China. I mean, China arrivals are still growing about 50% year on year. So, and close to half, about more 40% of all the arrivals now come from China. Retail sales in Singapore is weak. So retail spending is big. All the discretionary items like computers, watches are all not doing well. But but supermarket, which is, you consider it like consumer staples, so that's holding well. But just that people are not spending on discretionary items. Construction continues to be do well, and then for 2024, the amount of contracts awarded was 30% growth. So you can expect 30% growth in a lot of construction companies, in a way like a baseline, because contracts awarded was up 30%. And the guidance for this year is about midpoint about 50 billion, which is a 13% growth. We still see the export markets in Taiwan and Korea starting to slow down, so 9%, so Korea contracting. So what we think is that there's probably a slowdown because a little bit because Chinese New Year is a bit earlier, and then also there's a post restocking because everyone was clearly, if you listen to all the port conference calls, a lot of them were just mentioning that there was a lot of restocking in the US. So that might slow down because of that, the heavy inventory that built up in the US. Payroll, which is jobs in the US, was weaker than expected, but they revised December. So in general, payrolls in US is still very healthy because of the government sector. We show you a chart later. Next slide. So I'll just move on to our tactical view. So it's a daily news. I mean, you're going to get whipsaw or whiplash from the movement. So the tariffs on, tariffs off. So Canada, Mexico postponed. This de minimis means in the US, if you have parcels less than $800, is basically tax free. So when Trump announced tariffs on China, all parcels coming from the US postal stopped. Any parcel that came from US from China was all completely stopped. So I think 30% of all the parcels actually, or 40%, comes from Shein and Temu. So this was actually a big negative for SATS, because SATS 30% of the business, but I think Trump lifted it. But again, you get this back and forth between tariffs and all these restrictions. The big worry now is that I think on Friday there was a media conference with the Prime Minister. Then he just said that there will be reciprocal tariffs next week, which means that he might impose tariffs on countries that have not that impose tariffs on him. Also, it's reciprocal, right? Like an eye for an eye tariffs. But even Japan is not immune. But we're not sure who is it. But all this is going to be a clear and present danger for Southeast Asia. So you can imagine if Trump mentioned he's going to impose tariffs on no point Singapore. Singapore's a deficit, but maybe Vietnam or even Malaysia, then the market could take a turn. So we are living in this clear and present danger every day, because depending on what he says. But to shield ourselves, I think we think sectors in Singapore that has momentum and more immune to the tariffs will be, of course, construction, like we mentioned. There's record orders. So even if Trump imposed tariffs, it's not going to impact that. Capital markets will still do well. I think the more he imposed, the more volatile. And then, of course, SGX, like we mentioned, will do well. Banks will also benefit because when there's volatility, there will be more hedging activity for their FX, which is foreign exchange activity. So their trading income will do well. Of course, wealth management will also do well because when there's more trading activity. Property, of course, continues to do well. Like Tua Payoh, like almost sold out at 2007. I'm not sure how that happens, but anyway, the new pricing for Tua Payoh is now 2007 per square foot. Of course, power demand is doing well. So Sembcorp and Keppel will benefit because the demand for power being guided by the EMA or the Energy Market Authority of Singapore said that I think the last 5 years the average was about 1% to maybe 2%, but this could double or even triple to 4 to 6% by 2030. Because we're going to force everyone to drive an EV. And then you're going to get more data centers. So also a lot of the power is coming. Some of the new plants, older plants are shutting down. So power is another sector that will be somewhat immune to the tariffs. Telcos could also do well because Singtel, Bharti, announced earnings that was doubling the earnings. So this will benefit Singtel too. And Bharti valuations is almost like I don't know 40-50% of the whole sum of parts for whole of Singtel. So these are the pockets where at least we can be a bit more immune to any tariff news. These sectors. There was also an update from SingPost, a very informal kind of update, but some of the key things, just for everyone's benefit, is the reason that they are selling their Australian business is because they said that SingPost was too leveraged. They're going to get a big return from it because they only put in 100 million and they're selling it for 1 billion enterprise value. And then operationally, it is soft. I think which was highlighted in the previous briefings. Australia is facing a bit of a soft patch in terms of operations and also staff retention, because they worry that some of these staff are actually getting a windfall from selling their stake in FMH, the Australian business, and they're just worried about the retention. So the key thing for the investors right now is the timeline. So the next stage should be to get the foreign investment. I can't remember what's RP, but it's a foreign approved. The Australian authorities need to approve this purchase because although SingPost owned by foreigner, but the new owner also has a foreigner. So I mean, it's just a formality because it's both as a foreign ownership. So once that is done, EGM will be held in March, and then by end March everything should be completed. But of course, the key thing everyone wants to know is when will they announce special dividend? It's a bit of still trying to get clearance, but they can only announce special dividend maybe only during their full year results. So anyway, in terms of our view, the stock price should still do well. I think the stock price can do well because once they announce the foreign investment approval and then they announce the EGM, and then we will approve the special dividend, then just that for us, once the special dividend is approved, we have no idea, but if you take the gains that they had, 300 million by selling Australia, you halve it, you're talking about maybe 7-8 cents. But just that we might not want to hold the shares once the special dividend is announced, because we worry that they announced 7 cents special dividend, then once the 7 cents is paid, the share price might just drop 7 cents. So we worry about that is because they may not sell SingPost Center because SingPost is worth 1 billion and the market cap is 1 billion. So SingPost was always look cheap because they have this mall or office to sell. But if the balance sheet is strong after selling Australia, they may not actually pursue selling it. So that's the risk. And secondly, you may not know how to value SingPost because their core business they may not have a core business until the Singapore postal system review is completed. And this will only happen, after the whole elections. So anyway, for us, we just think it's still a trading opportunity for now. But once they announce special dividend, maybe is might have to short-term release it because of the these two concerns that we have. Anyway, DBS released their results, CPI. So just to give you a bit of comment, which was made by Glenn. So the results was up 11%. It was strong across. The only negative was they made some bad debt provisioning, which I think it wasn't clear by the announcement yet, but maybe he can brief or in the P3 community. But the good thing is that their dividends was raised from 45 cents per quarter, I think, to 60 cents. And they're also giving a capital repayment or pseudo special dividend for the, I'm not sure how long, for the fixed few years. So if you add in that 75 cents, they are looking at almost 6% plus a dividend yield. If you remove that special dividend that they're going to pay every quarter, you're talking about maybe about 5% kind of yield for DBS. Yeah, but anyway, he can share more details. Yeah. These are some of the events we have, and no, feel free to dial in. Yeah. Next slide. So this is just an illustration of the chart. You can see that the loans growth, the dark blue line for Singapore is picking up, and this will be good for their net interest income. This is retail sales. The blue line is what we always focus on, because this is Sheng Siong in a way, because so that is actually not contracting. So that's holding up at 2% growth. Next slide. Tourism in Singapore is still holding up. It's still growing about 13%. And then on the 3-month basis, and most of it is because of China's 50% growth. On the right here is that although arrivals is rising, the RevPAR, which is basically hotel revenue, isn't moving much. I mean, it's still growing, but it could be just moving sideways. So the growth for hotels could be slowing down based on this chart. Next slide. If you move on to this, is just a job. So even though jobs disappointed, if you look at the trailing 3 months, you average it out, you can see that the jobs in the US continues to rise, mainly because of government. So government now is about 60 to 70% of all the new jobs. So when Dodge come in, I'm not sure how it's going to affect employment, but you can see pre-pandemic, it was used to be only 20-30%, but now almost 2 in 3 jobs all government related. So it's all about the government stimulating the US economy, at least from the jobs front. Next slide. Okay, this is our model portfolio. I had done it last week, but no, because of the new year. So this is how we perform. Again, this is just an illustration. It doesn't include dividends, brokerage, all that stuff. But so we did well. So construction and banks did well for us. China continues to underperform, like CapitaLand, China Aviation. These are the areas of weakness. We were below the market. Singapore market was up 1.8% in January. Again, this is all just for illustration. Next slide. If you move on to the sectors, roughly, telcos did well because I think Singtel share price did really well in January. And the other one is banks. If you look on the right, it's just a snapshot of some of the small mid-cap names on the top here, which is everything. So Southern Alliance, Jaffa, but then Southern Alliance was just one lot or something, so that's the anomaly. Then at the bottom are some of the big the large couple make the index weight stocks. What did well? So SES was the weakest, and then Singtel, Citron were the best performing. Then the banks and all that. Next slide. This is the performance by asset class. So what did well was geopolitics. So because of all the volatility, geopolitics, I think everyone is moving into gold. So gold did well in January. Interest sensitive names continue to be weak, which is the bonds, ETF, and of course Singapore REITs. Next slide. Okay, this is my last slide. So this is the performance of all the Asian equity market in local currency terms. So tech did well. So you look at South Korea, Taiwan, that did well for technology, even though we are DeepSeek. And then financials, Singapore financials as well was on a better performance. I'm not sure why, but across the board was Southeast Asia all did badly. Philippines, Thailand, Malaysia, China all did badly. Anyway, this is just for reference. We can move on to Q&A.
Yeah, let me take on some. If you are given a choice, which stocks will you go for? CICT, Maple Street Industrial, MLT, Wilmar, please provide a reason behind the selection. Yeah, so for Wilmar, I'll leave that to Paul, but for CICT and MLT, CICT, their portfolio is very resilient in the Singapore space, 95%. So from that perspective, we see operating performance doing quite well as well. Like I did a feel on the ground. So CICT might be a good choice. For Mapletree Industrial, there are some leases that are expiring, and there's a little bit of weakness in the North American data center space. And for Mapletree Logistics Trust, the share price has really been hit, but we do see signs of recovery in the China side. So China has been the drag for MLT for the longest time. Like for the past few quarters, it has been a double-digit negative rent reversion, but we think, and it's also been guided by the company that they might still see a low double-digit negative rent reversion for one more quarter, but after which it will start to improve from 2 quarters down. So there are some signs of recovery as a lot of the rents have been kind of already marked to the lower market. Yeah, so for the stocks, we'll go for probably say CICT and MLT. Yeah. What's your recommendation on Keppel REIT? Yeah, Keppel REIT we do not cover. But for I'll leave that to Zin for the TA. But for Keppel REIT, basically the potential for positive rent reversions are still there, possibly in the high single digits and low teens level, as their portfolio is relatively inside the core central region where we see the new incoming supply is more of the fringe areas, so they are not really impacted. And there is still demand for space for office as well. And IOI Central Boulevard has already been 80% filled. Yeah, so the pressure from the new supply last year is, guess, relatively waned already. Yeah, so that's for REIT. Thing jump. Thanks, Mira, for the update on Lendlease. Yeah, maybe I had to rush off to another meeting, so I'll be covering. Yeah, what's the current status of the joint venture with Singtel HQ site development? Yeah, I'm not sure what you're referring to, but I think what you're referring to is the development of the com center. Yeah, so that is not with Lendlease Global Commercial. It's with the parent Lendlease. Yeah, so few years ago, Singtel, they announced that they'll be partnering with Lendlease to redevelop Con Center into a $3 billion sustainable workplace, like smart building and digital technologies and such. Yeah, so that is the redevelopment with the parent Lendlease and not with the Lendlease Global Commercial REIT. Yeah. Let me see. How was Ascender Street results? Yeah, so Ascender Street's results were quite strong. The rental reversions were 11.2%, and they also had some interest cost savings. So as a result, their DPU was up year on year. Yeah. Going forward, we think Ascender Street, the rental reversions outlook is more probably mid-single digit rental reversions. And this is based on where the current market rents are. Yeah, and for Singapore business parks, they're still performing better than the industry. Yeah, but they like over this quarter they brought in new industries like aviation, education, and medical. So all these might help to boost the space. But we still think business parks still weak and possibly low to mid single digit positive rent reversion for that as well. And yeah, they have a lot of AI plans upcoming as well for Ascender. So the outlook for Ascender is still quite positive. Yep. And their portfolio valuations are also stable year on year. So Singapore saw some portfolio valuation gains, is slightly offset by some overseas weakness. Yeah, in Australia. Okay, for FLCT's results, yeah, they had some good results. The positive rent reversion for Australia was very strong, but the office side still remains weak. Yeah, Google is going to leave the space this year, so there might be some so-called absence of contribution there. And for this year, we do expect DPU to drop year on year for that as well, for SLCT because of the Google space as well. And they've also guided that it's likely the DPU will decrease and they might possibly top up DPU. Yeah, so going forward, FLCT, their logistics portfolio still strong, but we think might have peaked and rental reversions might start to slow for the Australian side. And for the office properties for FLCT, yeah, it's not doing too great. Yeah, so that is our take, especially those overseas properties, overseas assets. Why is Keppel DC REIT price volatile? Yeah, so Keppel DC REIT's price has always been volatile. Because personally, I think it's because it's linked with a lot of AI plays. So any news regarding AI, Keppel DC will also run. Like we saw the DeepSeek news, Keppel DC share price just plunged 7% that day. So Keppel DC REIT is beta is definitely higher than a lot of other REITs in the market. Yeah, but regarding why it's so volatile, I'll leave that to Zane to do the technicals. Yeah, I'll hand over to my colleagues for now. Thanks.
Thank you, Darren. I'll take some. Hi, Helena. What's your take on XPEV? I think Glenn is now with us today, and we don't really cover the company, so I guess I'll leave her. Can you give your view on Amazon with its rule of 40 at 32%? I'm not really sure like whether you're asking about how it works or whether command that it's not met 40%. Just to answer both for those who didn't understand the context. So the rule of 40, we actually introduce it as a benchmark to kind of measure the balance between the growth and profitability. So what we do is we adding the both matrix that represent the growth and profitability. In this term is the 3-year average revenue growth and the EBITDA margin. So we add it together. So if it exceed the 40% threshold, then we deem that it's a stock that's worth investing in. I guess in Amazon's case, their revenue growth has slowed down quite a bit since 2022. But they're slowly starting to pick up the speed in 23, and we start to see it more obviously in FY24. I guess such is the same for big companies. So in the beginning stage where the growth rate was really high, it's really pushed by AWS because that time AWS was really rapidly expanding. So their growth rate was as high as 40% year on year. So that seems to slow down. But I guess the good positive thing that we still see is they're slowly to pick up the growth again. And this is extremely hard because they've already reached certain scale. And especially in the retail side, I guess the past 2 years has been pretty tough on them because we start seeing consumers start trading down, start looking for discount. So I think overall they did quite a good job into transforming themselves in order to match up with the changing consumer preference. So yeah, I hope that answers your question.
Helena, I think maybe the question is why is it in the rule of 40 because it's 32, right?
Yeah, so if we use the rule of 40, we add up, it's actually 32. It doesn't really meet the 40% threshold. But I guess it's a big company, so I would say we're still quite positive on Amazon given the growth rate that they have. I guess that's pretty much for me. Any comment on Google result? I guess I can talk about that. Google, I would say to look at their revenue growth was quite robust. Their Google search was growing 12.5% year on year. YouTube grew almost 14%. Their cloud was still pretty strong momentum. It grew 30%. So I guess overall, if you just look at their top line, I believe their Q4 earnings were quite bullish. So what the investor don't really like is they've announced that they're going to have a capex of over 75 billion. So in 2024, their capex was only 52 billion. So people start to think that the increase was a little bit too much. Since it's already at a very high level. But I guess the way you look at it is their cloud reached almost 12 billion revenue in Q4 versus only 9 billion revenue in 1 year before. And without the massive investment in infrastructure, this growth would not have been possible. So when they give out the outlook that they're going to spend 75 billion in the capex, I quote, they say we're confident about the opportunities ahead. So it is obvious that for a company like Google, they're not going to plan to put so much in investment without having a clear vision of the demand that they're already experiencing. So I guess this might not be a negative thing. So Amazon has talked about similarly, I guess, with the DeepSeek coming in. So Amazon's comment was, just because the price of AI went down, people intuitively think that the overall spend on AI would just decrease, but that's not likely so because everything is so cheap. So previously, whatever project that you don't plan to do because you find it too costly, now you actually start to exploring those projects as well. So in the end, your overall spend on AI might not actually be lower than what you plan to do it. So they are still quite optimistic that it's actually going to benefit the cloud industry instead of weighing it down. But John is no longer with us, so we don't really have the valuation for Google. I guess I'll leave it for Zane to do a technical analysis. Yeah, I guess that's all for me. I'll pass my time to my colleagues.
Thanks. Thanks, Helena. Take on some questions now. The first question is, any idea how far is AMD's GPU chips behind NVIDIA? I think the question is not very specific because we can look at this from a performance standpoint and a market share standpoint. So I guess I will just address both. So from the performance standpoint, the latest AMD chip in production is the MI 325 chip, and the latest NVIDIA chip in production is the Blackwell chip. So comparing these two itself, performance-wise, actually, they are both quite comparable. Both win in some areas and both lose in some areas. For example, the Blackwell chip, it actually beats the MI 325 chip in terms of raw performance in inference. For example, it has a higher petaflop but in performance compared to MI 325. However, MI 325 beat the Blackwell chip in terms of its memory because it can deliver a 6 terabyte per second memory as compared to Blackwell's 1 terabyte per second. Yeah, so in different areas they win in different areas. So it's quite comparable in terms of the chip itself. However, NVIDIA's software ecosystem is much stronger because NVIDIA has the CUDA ecosystem where a lot of developers use it. So it's very easy for developers to troubleshoot within the ecosystem and to use the whole ecosystem itself, as compared to AMD's ROCm ecosystem. So right now, NVIDIA still holds the majority of market share in GPU chips compared to AMD. Right now, NVIDIA holds 80% of market share compared to AMD in terms of GPU. Yeah, so hope that answers your question. There's a question about WeHer. TA for WeHer and when will the financial year result be released? Yeah, we are still checking with management regarding the results release date. So if you really want to know, you can send me an email. Then I can update you when I know. Yeah. I think Hi, Bun. Do you have a view on ARM? Since you mentioned ARM has withdrawn a threat to terminate Qualcomm's license. Yep. Just a brief context on ARM. We don't actually cover ARM, but I can give some insights to it. So ARM actually licenses its intellectual property to many tech companies and chip companies. For example, they license it to Apple for their chips itself. Also Samsung, Broadcom, Nvidia, Qualcomm. Yeah. So in terms of the whole big tech and semicon sector itself, generally right now is still in an uptrend because there's a lot of demand for the AI chips. However, when I took a brief look at the forward valuations itself, the forward PE seems a bit high at 86. And in terms of the licensing contract itself, my personal take is that ARM cancelling the lawsuit with Qualcomm is a win-win situation for both companies, because even though Qualcomm just makes up a small percentage of ARM's revenue percentage, because they also have many other clients. We do feel that cancelling this lawsuit brings ARM more revenue, because ARM actually takes in royalties and fee charges once they license their IP, and almost 100% of Qualcomm's chips are produced with ARM's IP. So if Qualcomm can continue to be in business and continue to sell their chips, ARM will also benefit as well. Yeah. So my personal take is that ARM withdrawing this lawsuit will actually benefit both ARM and Qualcomm. Yeah. And maybe that's why they cancelled it. Yeah. Okay, hope that answers your question. Hi, there's a question. Hi, Paul. You mentioned construction as sector with momentum due to record orders. Which counter specifically are you referring to? Because construction affiliates is quite broad. Yep. So in terms of construction as a sector, we like to play the materials as well as support services. For example, within building materials itself, we do like BRC Asia and Pan United, because BRC Asia holds around 70% of market share. Pan United holds around 40% of market share. So whenever there's a construction contract, they do need building materials, like for example steel, and they also need ready-mix concrete for these projects as well. So companies like BRC Asia and Pan United will benefit when there's an uptake in projects itself. Support services, as I mentioned just now, refers to, for example, worker accommodations. We like Centurion and WeHer, because naturally with construction projects, then there'll be a strong demand for worker accommodations. Even though right now the supply is almost the same as demand already. It has already caught up. So right now we do see a very stable kind of rental income that Centurion and WeHer can take in. For construction itself, just to elaborate a bit more, we don't really like to take on specific contractors, because we don't know how these contractors, what kind of projects they can actually take in. For example, a big project coming up this year is Terminal 5. We don't really know whether the contractor itself can directly take in revenue and profit from the Terminal 5 project itself. Yeah, so for example, if a project like Terminal 5, it needs building materials. So naturally, companies like BRC Asia and Pan United will benefit from there. Yeah. Hi, Bun. Any reason why Centurion can't move up to new highs after REIT listing news? Yep. I think my personal take is that the current announcement for the REIT listing is that they are still in the exploratory phase. So there's a lot of things that can happen because right now they are still in a very early stage. And actually, 10 years ago, 2014, 2015, Centurion actually tried to do the same REIT listing. However, it didn't go through because I think a lot of their property is concentrated in worker accommodations. So right now they are trying again because they have a slightly higher concentration in student accommodations. So they have a slightly higher confidence in successfully listing the REIT. Yeah. So maybe that's why people don't really see it as a super good news, rather because there's a lot of things that can happen because it's still in the very early phase. Yeah. I think that's all for now. I'll hand over the time to my other colleagues. Thanks.
Okay, yeah, thanks, Iban. Let me just move on to some. What's Phillip take on O&G stocks, especially? I think you're referring to Rex and RH Petrogas. Actually, to play, I guess everyone wants to buy the whole oil price segment. Usually, investors in Singapore usually we use Seatrium as essentially as the proxy rather than the explorers, because explorers, you have the additional risk of drilling and not finding any oil. I mean, in a very layman terms. And you've seen that in Petrogas, some of them they have actually had hit some, and most of these drillers have kind of huge capex. So unless you have some very deeper insights on the likelihood of them hitting oil or taking the additional risk, I think most investors in Singapore context at least, and these companies don't really share much anyway. So we end up just buying like Seatrium and all that as a proxy towards oil price. Yeah. So that's my general view. And there's liquidity there, and the services sector is what the market favors. Not so much the oil and gas operator, the O&G, I mean the exploration companies. Any possible reasons why ventures underperforming start of the year? I think maybe just some of their customers to monitor will be, maybe my guess is probably like Illumina will be one, Philip Morris. Nothing exciting coming out from those companies. I think that could be one reason. And the whole macro backdrop, don't think anyone is expecting anything strong coming up. So I think that's the reason why they've been underperforming for the beginning of the year. Yeah. And I think the whole tech sector also not doing particularly well for so far this year. I mean the electronic sector for Singapore at least. How much can SGX engineering contract awarded last week contribute to the share price? I think that 4 billion was, I don't know, a multi-year high on a quarter. So it should but quarterly contracts is actually very volatile. But I think market are still quite positive for ST Engineering, because they are still doing well in the firstly, there been another positive news was I think if you can see the road pricing in New York. Sorry, I just slipped my mind what's the name, but the road pricing in New York was resumed. So that was a benefit the acquisition that they made, TransCore. So that division is doing well. The electronic road pricing that went live, because it becomes a test case in the US that more and more countries in the US will do it. Defense is also still doing well because of ammunitions, and also their aeroplane O&M is doing well. So there's really nothing that was derailing the story 2-3 months ago. I think maybe the contract just give people more confidence, because the order book was a bit light as they ended the quarter, and this is like a multi-year high in contracts. So I think that kind of benefited them. For Rex, what drives the price? Rex, Intel, I'm not particularly sure for Intel, but anyway, Trump imposed universal 25 tariffs on steel and aluminum. Any stocks in Singapore, how they may be affected directly? There's no direct impact, because the only one is maybe BRC Asia. They might get cheaper steel. I mean, if some of the steel get dumped into Singapore, so it might benefit Singapore, because if the US is shut down. But I don't have the details like how much and who will benefit. But thematically, I mean, you can come up with this view. I mean, that if steel prices come down, it will benefit BRC. So that will be the indirect benefit in Singapore. There's BRC. Apart from that, there isn't any steel exposure in Singapore. What's the outlook for HPS Trust going forward under Trump? Yeah, okay. So for HPS Trust, the dividend yield is 9%, but I'll be a bit wary because they are facing a huge repricing of their interest. So their interest is going to rise by 3 percentage points, and I think their debt is about 2 billion. So I think they could actually carve out carve down their dividend by maybe 15-20%. Under Trump, they are seeing a bit of benefit. The volumes have been better than expected. I mean, that's what they said in early in for the December second half. They did well because they also mentioned there's a stocking in the US because of the Trump tariffs. But this won't be good because if the China tariffs come up, then you know the main route for them is actually China to US. So any tariffs, there's only downside risk. I don't think there's any upside with Donald Trump there because you know he's going to impose barriers and he's just going to slow down global trade. So I think HPH Trust, although 9% yield, I think there's a lot of pressure for them. For the next 2 years, they need to reprice their debt up 3 percentage points. I think that's going to be the big headwind for them. And at the same time, you know, with all this volatility and tariffs, maybe they'll be on, maybe they'll be off. I think there's probably one trust that maybe investors might maybe stay away from for now. I mean, that's my view because their ports are mainly Hong Kong and China. Although Hong Kong is really hollowing, Hong Kong is not doing well. But their Yantian in China is doing well. But the problem for China is that it is only 50+% owned, and most of the cash is actually stuck in China. And then when they want to pay out the cash, so half of the cash that you see on the balance sheet actually belongs to China. So, yeah, so that's why it's a bit worrying for me like this. Wilmar released for results forecast to be strong. I'm not too sure. I'm a bit wary for. I mean, we thought it would be strong in third quarter, I mean, but it didn't come in because China has been weaker than expected. So that's why I'm a bit more wary of the results coming in for Wilmar. They will do the brief and on Thursday of next week, or Wednesday. I don't know, either Wednesday evening next week or Thursday morning. That's the results. And also buying into Adani at, I don't know, 20+ times PE. I don't think it's going to be EPS earnings accretive. So I'm a bit more cautious on Wilmar. But no, don't take my word. I thought the quarter was going to do well anyway. Yeah. Hi Paul team, please update the Jaffa privatization offer status. Seems scheduled date status not available as of Friday. Yeah, it will take some time. So Jaffa announced a privatization through scheme of arrangement at 62 cents. So there's going to be a court hearing. Then after court hearing, there's going to be a scheme for shareholders to vote. They need 75%. Usually it takes 6 months before delisting. If you take EC Tan, so EC Tan also did something similar. They made an offer 1st April, and they got delisted only in September. So almost 6 months. So you can assume that will be the timeline for that. So it will take time to get this because they're going to go through court, need to get independent financial advisor, circulate to investor, give notice to investor, and get investor notice, then check the acceptance. So it's going to take some time, at least 6 months from offer period to actual delisting. We'll use ECTAN as a case study. Hi Paul, any prediction for US CPI trend going forward? Is deflation? I still think it is probably not the most popular view now because I think shelter inflation has turned the corner. So shelter inflation was the one that has been stubbornly, it didn't go down much, but it's turned the corner. So, and you know, last year of 2024, inflation was exceptionally high month on month. So I think the next 1-2 months, you're going to get good inflation reading. I mean, that's my own view. Please comment on the REX reprice upward. I really don't know idea on REX because REX very complicated because you have to take a view that of their reserves that they had, that how much production they have, and they don't update investors on anything. Yeah. So I really very hard to get a sense of what's going on REX. I mean, yeah, sometimes don't have to go so complicated stuff in a way, I guess. Okay, what's your latest update on Yoma? And I think the only news I saw on Myanmar has been that I think Thailand has stopped some power production, but mainly to the north. I haven't seen any update. I mean, the only news you want to know for Myanmar is they are going to hold elections. Until that, everything is probably just going to be negative. Unless they hold elections, although it would be like Thailand, no military supervised, no military, but until that, it will be hard to give a strong macro view on Yoma. Yeah. The technicals, I'll leave it to Zain. Thai Bev, any update? Is it hot by FX or yeah? No specific updates. Probably Sabeco is announcing their results soon. on Thursday. Maybe that might give a bit of momentum because the Sabeco, which is their Vietnam own subsidy, that those earnings should be strong. So because it's going to be the new year and they are beginning to recover from macro wise, so you could get a bit of momentum from Thai Bear Fund Sabeco results comes out on Thursday, Wednesday, sorry. Thursday, sorry for that. Yeah. Can you please comment on the growth of Baostate? Is it decent move? And yeah, so Baostate has largely three parts of the business. There is the S3, I hope I pronounce it right, the GIS. So that is the real jewel in the business. So that's the geographic information system. So for that, even so it's like Singapore also use it here. It's like they can map the underground system in 3D. It can map all the points. Like I'm exaggerating. Can map a single crack in the pipeline or map everything, manholes, everything. Example of a building, the 3D schematics of a building in 3D in software form. So they are a global standard. They are the main. But it's just that the growth maybe 15%, 20% kind of growth I'm taking. And the other division, Baostate project, so that we think is not doing too well. So that is more like if let's say Applied Materials come to Singapore, they want someone to arrange the land, design everything, buy the land, but Applied is not doing that anymore. Applied is doing it on their own. So that's why that business is weak. And the other next business they have is a fund that owns industrial property. So I guess that is fine because Singapore valuation. So it's just that the growth might be a bit, it's a good company, just that the growth might be a bit slower. Maybe I'm talking maybe 10-15% growth. So for a small mid cap, just depends whether investors have appetite for that. But it's definitely a good company because of their GIS system. What's the view on iFast results? I've really Glenn is not around, but I think the results should be strong because of their new UK business, their new digital bank they have in UK, so that should be doing well, and of course Hong Kong too. So, and I think like the whole SGX market. I mean, if you want to play capital markets, iFast will be another because they are technically a broker too, just like UOB, the listed UOB Kay Hian. So they will definitely do well when capital markets are vibrant. Yeah. Okay, can you provide on, I'm not sure what DDOG. Hi, Pom, talk about reciprocal tariffs. Any guess which countries will be on the dartboard next? I think Trump has mentioned tariffs on on Europe and tariffs on Japan. So you keep your fingers crossed. They don't talk about Southeast Asia, but I think Europe and Japan will be the most likely ones. Hi, any possibility Singapore Tech, Franken, UMS, AM, Grand Venture can benefit from? They can benefit indirectly in a way because if you look at someone like Perplexity, so Perplexity is actually taking DeepSeek's engine and then hosting in their own website. So they will probably need to buy more. I'm just making a story here. They need to buy more GPUs and all that. But like what was mentioned by Helena, I think most of the hyperscalers, your Amazon, Microsoft, Google, they are not cutting back on capex. So the beneficiaries of AI will be Franken through more HBM memory, would be UMS in a way, and AEM edge. All four will benefit, but you just have to wait a while. Just that again, like we mentioned before, I think fourth quarter earnings should be weak because there was a lot of pooling in orders last year. I mean, talking about 2023. So 2024 will be weak, but I think after that, the semicon names, I think in general should be fine. Because the capex spending has only started to go up. So I think a lot of and you can, I think like what Yip Ban mentioned, a lot of the equipment guys like ASML, Lam Research, and hopefully by Applied Materials coming this week, have all given strong guidance for their upcoming quarter. So this will benefit all the Singapore semicon names. But just that fourth quarter, don't expect anything. It's going to be big. And your view on landlord Yanlord. So Yanlord is a Shanghai developer. There was actually just this morning there was a call by Fraser's Property. So they have property development in Shanghai. So Shanghai is still doing reasonably well. Their sell-through rates is as high as 70%. Just that I think for Yanlord you have to take a long-term view. I mean, near term you won't. The property will still be sluggish, but the one thing good about Yanlord is that it survived. I mean, it's one of the few private developers left all the large one in China all knocked down. It's probably all state-owned companies left. And longer term, there are many in Shanghai, so that will still do well. But you just have to take a medium-term, longer-term view for Yan Lot. I think once you survive, so long as you can survive this whole malaise, you are fine. I think the whole balance sheet can take this like really a deep recession or depression in the whole China property market, especially for developers. With Dodge slashing federal jobs, will this mean low non-farm payrolls? There is a possibility, yeah, but I don't. You probably see in February onwards. But it depends. The market might see this as just a one-off. But it's a valid point. I mean, it could happen in February, not in January. You won't see because Trump only inaugurated in January, so this could have a negative impact on payrolls. Then you have to see how the Federal Reserve views this. Is this just a short-term thing, or is it his usual word, not transitional, or is it going to be a structural thing, reflection that going to be a weakness in jobs data? But it's a valid thing to watch. Yeah. So it really, I don't know how the Fed's going to interpret this. If they see this as a weakening of jobs, then it's very good. Then there's more chance that they will cut, because right now the Federal Reserve is on the hold. iFast Buhai's moving a comment. Yeah, I think I mentioned that. So iFast, like I said, capital markets is the way to play for 2024. So SGX, iFast, UOB, and all those. Yeah. Any prediction for US CPI trend going forward? Is deflation? Oh yeah, I think I answered that. Oh, sorry, I forgot I answered that. Yeah. Okay, I hand on to the rest. Yeah. Yeah. Thanks for all the questions, everyone. Hopefully it was helpful.
Thanks, Paul. Okay, I'll answer the TA questions. So let me just share my screen right now. Yeah, so the first question I see is about OCBC. I'll talk about the Singapore banks also. So for OCBC today, there was a gap up to retest this previous swing high close to 1760. Maybe a bit of a resistance over here, but I do think that it is still likely to see higher highs ahead. Because since November over here, this stretch is just a very gradual uptrend, still higher highs, higher lows. Then recently, there's also some consolidation taking place. And this $17.20 bottom resistance became a support. So overall, I think still very bullish. I think still like possible to see new highs ahead. UOB today also similar kind of price action. Yeah, retesting this swing high around close to $38. Bit of a pullback for now, but I do think that still likely to see higher highs ahead. So yeah, because the chart is actually quite similar to OCBC. You still have a consolidation, higher highs, higher lows, very gradual uptrend as well. Then afterwards, then next one, talking about DBS today, there was a gap up around for open at 45.60, push towards 46.50, and now there's a bit of pullback. Overall, I think for now we still overall need to see how the second day of trading, only tomorrow, does see that there's some follow through or not. But for now, we could maybe see some pullback, but I expect price to be supported around the $45 to this $45 to 45.40 area. And overall, then there's also this trendline support holding the price as well. So maybe a bit of a breather, but then price is likely to continue to see high highs going ahead. Yeah, as for STI today, since we're talking about banks, I think it would be good to talk about STI as well. For STI today, we actually had a new all-time high. So that's 3921. The previous high was around 3906 in 2007. Yeah, so we made a new high today, but I think let's see whether it can close. I think I'm still positive for new record high close going ahead, given the kind of this gradual uptrend we are seeing in STI as well. Okay, then next question I'll talk about is 9868, which is Xpeng. And so for Xpeng, I think overall still looking quite good. Breaking out in terms, it broke out of a consolidation between 43 to about $60 over here recently. A bit of a slight consolidation over here. I would expect some resistance to come in quite close to about $72, $73 about here. And there was a horizontal resistance passing at this trendline resistance as well. Yeah. For now, I think I would expect some consolidation with support to be found around 64 to 65 area. Then it could continue its uptrend afterwards. The next one is 1038 Hong Kong, which is CK Infrastructure Holdings. So for this, I think it looks looks quite like a range to me between about $50 to 58. We have a slight price weakness recently as price is it couldn't hold around the 54 to 55 area, this breakout over here. So I will expect some further pullback towards close to this support around $50.60. Then I'll expect price to rebound from this level. Okay, next is a TA for WeHer. Yeah, for WeHer, I think it's on this gradual uptrend as well in an uptrend channel over here. Today retested the swing high around 51 cents. Over here it meets with the channel resistance as well. So that we could see maybe some slight resistance will come in with a bit of a pullback, but we'll expect price to find support continuing on at a higher low, perhaps around 59.5 cents, this level where it was a consolidation resistance. Then I will expect higher highs going ahead in the short term to test towards this 54.5 cents level, which was the previous high in October last year. The next one is on Semco Industries. I think for Semco, last week there was a breakdown of this uptrend support line. So a bit of a slight declining in bullish momentum with the breakdown of this $5.47 horizontal support level as well. I will expect price to pull back slightly further, possibly to retest this around $5.30 swing low support. Then maybe just sideways for a while between about 530 to 550 area. Next one is for sets. As for sets, I think overall momentum is still quite weak. Last week we saw price actually retest this previous resistance level around $3.30. Currently, they're still holding below it for a few days. And also when we look at the moving average, it's currently below the 5-day moving average in blue as well. So that's it's for now quite strong bearish momentum. I would still expect price to go lower following if it breaks down below this recent short consolidation below $3.23. Then next level of support will be around $3.13. Which would be our second take profit level for the technical sell call I think a few weeks back. Yeah. The next one is for Keppel. And for Keppel, I will expect still some consolidation. Price is still holding support around 670, but resistance is slightly around 690. So just very sideways still for now. Next up for Mapletree Industrial Trust, I think for now it's starting to sideways a little bit at a support level around 209. But resistance is slightly around 215 to about 218. We have this downwards resistance line holding the downtrend as well. So for now, maybe some sideways consolidation between 209 to around 215 to 218. Okay, then for Rex, Rex International, I think very, very strong momentum recently. I think just clearing a few resistance level at one go. So for now, next level, I think there's a bit of resistance could be close to the 18 cents level, which was this consolidation range back in December 2023 to January last year. Yeah, the next one will be the swing high around close to 19 cents level. So for now, I think still go with the trend, I think. Yeah, since a very strong momentum, still no signs of easing yet. So it could still possibly hit these two levels. Next one, why is about Keppel DC REIT price? So for Keppel DC REIT, I think overall it's in the range consolidation. A very strong resistance is close to about 2027. The strong support is around 209 to 10 level. So for me, I think it's still in the range bound pattern, just moving sideways for a very long time. As long as this trend line support over here, it still holds as well as this horizontal resistance around 209 to 212. This area still holds as support. I think you still likely hold in a bit of a range over here for now. Okay, the next question is on Tencent. For Tencent, I think this action is still quite good. Since the breakout of this 392 levels, there was a few this gap of 413. Afterwards, did a bit of a slight consolidation, but afterwards still continue to push above the resistance at around 420. And currently it's around at this key resistance level around 430 over here. So I think where if you can do where there might be still some resistance where it could do a bit of slight consolidation, but if you continue to hold a higher low above like 420, I think it's still positive for price to actually have higher highs ahead. Since it's a gradual uptrend over here towards next key resistance, I think will be closer to about 465 to about 480 area, which was a swing high form during October last year when the Hong Kong stocks surged. Okay, then there's a question on TA for venture. For venture, I feel that it's a gradual downtrend, making a series of range consolidation, and then afterwards we see breakdowns a few times over here in October last year. Currently, end January we also have a breakdown below the 1270 level. So here likely to hold as a bit of resistance, I feel. Yeah, and support is around $12, which there was this hammer candlestick which tested the lows just I think last Wednesday. So over here, I will expect still some resistance around 1270 to 12.8, around 88 over here. Just probably continue some range consolidation for now. Next question is on Hong Leong Asia. So for Hong Leong Asia, I think still very gradual uptrend over here, just quite nice, holding along this trendline support, and also price holding above this breakout at 95 cents. So maybe it's doing a bit of a consolidation over here, where it's coming close to the 10 and 20-day MA as well, this area where in red and orange. Sorry, a bit confusing, but every time over this area, the price tends to rebound. So I will expect something to take place similar over here, around 95 to 96 will likely hold. 95 to 96 cents will likely hold as support for price to rebound, and I will expect a continuation of higher highs going. Next question is on Grand Venture. So for Grand Venture, I think there's some weakness, I feel, because since the breakout of this 88 cents, it was a failed breakout where price could not hold above it for more than one trading session. Afterwards, it came back all the way to test the support around 80 cents level, and we've been seeing very weak bounce over here on lower volume. So very signs of, to me, it's a sign of weakness. Also, we see MEC is a bearish crossover as well. So I would expect price to possibly break down below, if there's a breakdown below 81 cents, to maybe retest this level at around 77 cents in the short term. Okay, then for prop next, I think it's a gradual uptrend over here as well. Today there's a breakout above $1.10. So it's close to the previous swing high resistance around $1.14 back April 2023. So this might be a bit of resistance in the short term. Yeah. But overall, the uptrend is still very much intact, with a very steady uptrend. Okay, then there's a question on Lion OCBC, Hansing Tech. So for this, I think it's very good. It's in trading in this uptrend channel as well recently. This today looks like there's a retest of this around 89 cents level. So there might be some resistance given the high volume created last time, where I will expect price to do a bit of sideways consolidation, but to hold support above 85 cents over here, which was this breakout level. Yeah, so maybe some consolidation over here, then it could resume its uptrend afterwards. Okay, then maybe I take some of the US questions on for DOG, which is Datadog. Datadog, I think it's still has a bit of a pullback recently, but overall still in terms of a mid-term view, it's still holding above it's still an uptrend, holding above this trendline support, so which is around 140. So for now, it looks like a bit of a consolidation over here between 140 to about 146 for now. Yeah. if it, I think there's some weakness, only continued weakness if only it breaks below like 137, 138, this swing low. And then it might go towards like 131, this level. But for now, I do see some consolidation first. There's also, I think, earnings release coming up this week. Okay, then there's a question, what's the view on Lendlease? I think Meow is not in now, so I'll give my TA view on it. For Lendlease, I think likely to see some consolidation with a downside bias. So for now, it's holding at this swing low support around 51 cents level. But if it does break below this level, I would expect next support level to be closer to about 49 cents level. And since we're still seeing lower highs and lower lows along the way, for now, there's some resistance will be this 52 cents level here, which was a breakdown. Okay, then for Palantir, is the recent price increase sustainable? Okay, I think it could still be sustainable. I think this gap is due to the earnings over here. Seems something similar over here. So it was, even though there was a gap, price still gradually went upwards. So for now, we might, thanks to the price action, there was could be some profit taking on Friday with some increase in volume over here. So over here, we might see a bit of a consolidation might take place for a while first, but I would expect price to hold some support 104 to 107. Then it might do a bit of a sideways, then it might do a bit of a sideways first, then afterwards possibly continue its rally. Then that might make it more sustainable. Yeah, since it's not price is not rising in a straight line 90-degree fashion for now. So I think it could be sustainable. Okay, then there's a question on Yihang Holdings. Yeah, so for Yihang, I think breakout of a consolidation over here at $17.50, and also closing the above this resistance at $19.50 on Friday with increased volume. So I think possibly could still catch on this recent momentum to actually try to test some of the levels around 21.20, and then this would likely be a key resistance at $23. This swing high on the high volume back in October last year. Yeah, so short term wise, I think it could still ride on this momentum upwards even more. Yeah. For next question is on SoFi. For SoFi, it's a bit of, I think for now it's likely to be range bound because in terms of here, when price tried to break above $16.70, I couldn't hold above it. And after I think it was earnings that was gapped down, and subsequently this breakout level became resistance, and we're seeing weakness where price broke below $15.70. So that I think we could still expect some sort of a pullback to maybe retest this support region, which is around $13 to about $13.80, this level. Then maybe some rebound again afterwards. Then for SoundHound AI, for this I think just quite sideways since the breakdown of $18 into resistance. Then key support is still holding around close to $13. So I think for now it's just a bit of sideways consolidation. Yeah, I think I'll take one more question on the TA for NVIDIA. Yeah, for NVIDIA, I think is doing a retest of this $130 range consolidation breakdown. So 130 to 153 was this previous range consolidation it traded in from October until this DeepSeek gap down over here. So for now, this might still, I think this 130 level might still be some sort of a bit of resistance over here. Then price, and then when I pull out the moving averages, this is also the 20-day moving average as well. So I would expect price to do a slight pullback over here to try and retest this 5 and 10-day moving average crossover level. That's about 123 to 124 level. this might be the short-term support. So maybe a bit of range-bound consolidation still between like 123 to 130 for now for NVIDIA deal. Yeah, so I think that's all for the TA. For here over time to Barry. I think there's some questions for him. Thanks.
Yeah, thanks, Zane. Between MLT and Maple Industrial, which is a better choice and why? Yeah, so for between those two, they are not like for like comparisons. But personally, I feel I will go with MLT. So that's because we see the potential recovery already in their portfolio, especially the Chinese asset side. And for Maple Street Industrial, they have some leases that they have to backfill because there were some vacates in this quarter as well, like especially in the data center in NAs in North America as well. Yeah, so personally I'll go with MLT as there are signs of recovery despite both of them, their share prices being relatively weak. Yeah. Uh Digital Core REIT. What's your view on Digital Core REIT for upcoming financial results? Yeah, so we expect the LA property to be filled up more, and we also expect around maybe a 10%, upwards of 10%, low teens reversions for that, and for the rest of the portfolio, probably around mid-single digit for the coming financial results for that Digital Core REIT. Yeah, last question is directed to Meow Meow, but unfortunately she is in another meeting, so I'll try to answer that on her behalf. What's the update on FEHT results will be out this week? Yeah, so FEHT results will be out this week. We are expecting low to mid-single digit RevPAR growth for FEHT, and possibly with a slight increase in occupancy as well. Yeah, so that is expectations for FEHT's results this full year 24. Yeah, hope that answers questions. Yeah, I have a time back to Paul. Thanks.
Yeah, thanks. I think the Yoma one, I think you did done. I think it's a technical for Yoma. CrowdStrike, apologies, we don't really cover this stock, so sorry for that. So I think that ends it. I'd like to thank everyone for your time. I think the Straits Times in the Singapore market, I think, hit all-time high at 3912 just now, intraday. After 17 years, so I'm not sure should we be celebrating, after 17 years it just went back to square one. But anyway, just for your info. But anyway, I'd like to thank everyone for your time and for all your questions, and wish everyone to have a wonderful week ahead, and thank you for all your questions. Yeah, I hope to see you again next week, and do sign up for any of our webinars. Thank you everyone, and have a good day ahead.